These talks are brought to you by Claritax Books and are proudly sponsored by 6 Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. Last week we looked at a number of practical issues concerning claims for AIAs. We're looking today at a further 5 such issues and broadening the scope out a little. Now the first point is an obvious one, but important nevertheless. As we've seen in earlier talks, a business that sells a property will need to have captured the value of any fixtures and must then negotiate a sale value. Now the claim can be made at the point of sale, but there are at least 3 good reasons for doing it sooner. First, the business may as well have the cash flow advantage of claiming now rather than later. If the claim is delayed, it will not grow with inflation. Second, the transfer value on sale will be a matter of negotiation, but most purchasers will not insist on a value that would trigger a balancing charge for the vendor. The starting point for a negotiated election value is often the tax written down value, so by claiming sooner, the owner may permanently enjoy more tax relief. And finally, there will be plenty of other matters to worry about at the time of a business sale, and many vendors give away more than they need to in capital allowances terms simply because they're under so many pressures at the point of sale. Planning point 2. If a major refurbishment is contemplated, it's essential to capture the value of the old fixtures before the work is undertaken. Allowances can only be claimed for assets that are still owned in the chargeable period, so the capital allowances claim should take account of the old assets as well as the new expenditure. The fact that the outgoing fixtures are old and dilapidated does not necessarily mean that the capital allowances value is low. Point 3. Remember that annual investment allowances and first-year allowances can only be given for the year in which the expenditure is incurred. Take, for example, a business that buys a new machine for £100,000. If it claims immediately, it can get tax relief on the full £100,000 in year 1. If it delays the claim by even 1 year, it will get no relief in year 1, and its relief in year 2 will be restricted to just £18,000, with annually reducing amounts thereafter. Point 4 is for sole traders and typically relates to cars, though it can also be relevant for other assets. Suppose that David is self-employed and spends £30,000 on a car. The CO2 emissions are quite high, so the cost is special rate expenditure and allowances are given at just 8% per year. He sells the car after 3 years for £14,000. If David claims that the car is used for business purposes only, it will go into the special rate pool and he will only have enjoyed tax relief on about £6,640 when he comes to sell. What's worse is that the remaining relief will be given very slowly over future years. However, if David acknowledges that he makes occasional private use of the car, say 10%, then it will go into a single asset pool. Allowances will still be given at just 8%, but this time he will get a balancing allowance when he sells. So slightly less tax relief overall, but a much better cash flow, and almost certainly more realistic in the eyes of HMRC. Finally, as point 5, remember that AIAs and writing down allowances can always be restricted. So if there are losses, for example, or if the personal allowance is not going to be fully used up, it may be appropriate to reduce the capital allowances claim. Next week, we'll consider why the short life asset election is once more growing in importance. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.